No, that's what caused Lehman Brothers and the entire fucking financial system to blow up. Yeah, these things happen.
Yeah.
They're not inherent in crypto. But my biggest point, and I'll say it time and time again, is whenever people are critical of something like Aave and Maker and DeFi, I'm like, at least you know where that money's going. And you have full transparency into that process. Whether you want to look, that's your problem. And that's on you. It's always on you. You always bear the responsibility. It's, at the end of the day, your money. But it's your money when you deposit in these protocols. It's not your money. It's not your money when you deposit in a bank. There's a very big difference.
All right, everyone. So on Empire, you obviously know that we talk a lot about the institutions coming into crypto. And that is why we are super excited to share that we are hosting the Digital Asset Summit. We've hosted this since 2019. It's coming up in London, March 18th to 20th. Don't miss your chance to get ahead of the curve. You can get 20% off with code EMPIRE20. We'll see you in London. This episode is brought to you by Northstake, the secure and compliant staking platform for institutional investors. Northstake's ETH staking service lets institutions earn staking rewards while maintaining maximum flexibility on all of their capital. You can learn more about Northstake's institutional staking services by clicking the link in the show notes or that QR code that is on your screen right now if you're on YouTube. Now, let's get into the show. All right, everyone. Welcome back to another episode of Empire. We got the Roundup. Santi is coming from... Can you say where you are now?
Yeah, I mean, I tweeted about how great coffee was in New Zealand. It is a beautiful country. I've been down under for a while now.
I love it. Coffee.
Yeah,
is my
good trip.
So far, it's been great. Yeah, I mean,
Nice.
I met with a lot of the founders that are there, like Kane. Kieran's there. Robbie at Immutable. We recorded an episode. Met with a couple of funds there. It's just like a very vibrant ecosystem. I didn't go to Melbourne, which also has like other folks there, but really, really nice. It's actually an amazing country, which most people don't appreciate. Like Australia is really big because, fun fact, that Australia is almost the size of the United States.
I don't believe that for a second.
You don't believe
I don't believe that.
Wait,
I don't believe
this
that.
way I don't believe it. If you look at Antarctica, basically the way cartography and the way maps are drawn to fit in this kind of, when you look at a globe, when you flatten it out, what is closer to the equator is true in size. As you go farther,
Yeah, it gets stretched out.
No, the size is disproportionately smaller. So when you look,
at as you get away from it, then it gets smaller. Yeah,
right.
of course.
As you get away from it, basically it looks smaller than what it actually is. So Australia, being quite south, looks smaller than the United States, but it actually is very, very similar in size. Now you're Googling this right now just to verify this, but I'm pretty sure it's
Fact checking you.
Yeah. It's like it's smaller, but it is not that. Like it's not like as small as most people think. Most people think
size as US.
Okay, I'll put it differently.
Oh shit! Yeah, you're not. Yeah.
I'm not like I when I say stuff, I like
80. It's 83% as big. All right.
It's a Pareto. 80 flying from Perth, which is on the west coast, to Sydney, 6 hours. How long does it take to fly from San Francisco to New York?
Yeah, 6 hours.
Depends on which way you go, right? Because the Gulf Stream.
Yeah.
But yes, 5.5 to 6 and 50, 6 hours 15. But
all right, so do you want to start with the good news or the bad news? We want to start with Ledger or FASB? In my mind, those were the two biggest things that happened this week. We can also talk about Solana fee markets. We can also talk about points. We can talk about Eclipse testnet, Manta L2, Solana NFTs. People hated that we talked about that too much the other day, so we could continue talking about it.
Really?
Yeah, I got a lot of messages saying you guys are just trying to shill Solana NFTs, and I was like, my friend, these things are up like 10x. That's why we're talking about them.
I mean, we're going to talk about stuff that we find interesting because, I'm sorry, folks, I'm sitting on a chair here
and I could be doing other stuff. And
I got so many salty messages that we were talking about Bonk, and I was like, I mean, you can hate it or like, go look. You should go. Yeah, go look at Chow's posts. I think Chow's been nailing.
Maybe we can talk about that at some point because I think Chow is one of those guys that is not afraid to look stupid and actually speaks the truth. And I think, it also speaks to this idea of it's very liberating. It has been for me. Like at some point you just say, I'm just here to talk about stuff because you're in the pursuit of truth. And Xiao is one of those guys that he's come on the pod so many times. People love hearing from him because he speaks the truth. Like, he generally doesn't care what other people think. He's just gonna the best. And I'll stop here. One of the best things I've heard him say is, you build community, make everyone rich. And that was true for Ethereum. We try to over-intellectualize how community was built and Ethereum alignment. Well, guess what, folks? There's a lot of Solana alignment now because the devs have made very...
it's the same reason why VC chains, like a VC chain, all that really means is that you launched at too high of an FTV so nobody could make money, so then they didn't get, they didn't have bag bias, basically. That's what a VC chain really means. It's not that everyone raised capital at some point. Like, everyone's technically a VC chain. A VC chain is you just made the mistake of launching it way too high of an FTV, so nobody got rich. Let's talk about FASB. Okay, so big. Actually, this was big news, but didn't get covered like it was big news. Obviously, Blockworks covered it pretty closely, but I don't think the industry was talking about it too much. So yesterday on Wednesday, FASB officially adopted fair value accounting for Bitcoin for fiscal years beginning after December 15th, 2024. And let me just give kind of a primer on why this is so important. So actually, if you looked at some of the folks in the industry, so Hong, the president of OKX, said, this is big news, even comparable to having one more pro-Bitcoin president in a sovereign country. This removes a system hurdle for companies to hold Bitcoin long-term in treasury reserves. Bill Barheit, CEO of Abra, said this is way bigger news than the Bitcoin ETF. This is huge. David Marcus, I think he was head of payments at Facebook, said you may think this is a small accounting change that doesn't mean much. It's actually a really big deal. This removes a large obstacle standing in the way of corporations holding Bitcoin on their balance sheet. 2024 will be a landmark year for Bitcoin. So the reason that this is just like a 2-sentence primer here, why this is such a big deal, is right now the way that Bitcoin is treated on balance sheets is it's technically, I think, treated as an intangible or something like an intangible. So the way that works is when the price of Bitcoin goes down, you can mark the asset, you can mark to market on the way down, but you can't mark it on the way up. And maybe you can give like another example of this or kind of what this really means. But like if Blockworks were to hold Bitcoin on our balance sheet and we got it at 40,000, it fell to 30,000. We mark it at 30,000. It comes back up to 40,000 or 50,000. We can't mark it back up at 40 or 50,000. So it's been a pretty insane kind of archaic rule. But the big update is that they are changing that so that crypto is going to be measured at fair value on corporate balance sheets.
Yeah, as you said, it is a long-term intangible asset. So it is like treated like think of it like a patent. And it's crazy to actually think about that. One, it's actually liquid, very liquid. So it should be not long-term, it should probably be a current asset, like a kind of like a marketable, like a short-term, and the other one is like, I think if you think about, like MicroStrategy, for instance, has a ton of Bitcoin in their balance sheet, right? Like as price has come down, because a lot of their, they've been buying at different levels, then when you look at their balance sheet, it's not an accurate representation of the current value of those holdings. Now, of course, people can do the math, right? You can go in there and say, oh, okay, they're holding 100 Bitcoin, that translates into X. And then their loan docs, right? Their covenants, they also obviously are marking them at, what is the fair value of that, which is what they could sell it for. So they're not like tripping covenants, but nonetheless, I mean, I think it's still important when analysts look at a company, right? And you're just looking at the financial health of a company. And if this thing is not being accurately reflected in the balance sheet, I think it's difficult, right? I think it may be yet another reason why, if you're on the fence about holding Bitcoin on your balance sheet, this treatment hasn't helped. And the fact that it's going now to a more accurate, treatment, not a patent, but something that is liquid and marketable, and and you can actually market to market, then I think it's I guess the real question is how many people.
I mean, this happened to MicroStrategy, right? So Saylor bought billions of dollars of Bitcoin. Price increased. He had to hold the Bitcoin on MicroStrategy's balance sheet at the purchase price. Then Bitcoin fell in value. MicroStrategy had to recognize what's that called? It's an impairment impairment listed as a loss. Then Bitcoin recovered in price. MicroStrategy couldn't recognize the recovery. They had to keep the value on its books at the impaired level, even though Bitcoin had recovered.
You're looking at all the metrics, right? And think about like how automated the stock market is. Like if you just look at like these current ratios and solvency ratio, the asset test, like all these like financial metrics, if you were to compare it, it just is out of whack. It's not an accurate representation, right? So yeah, I think it's important. The real question in my mind is the impact. I don't know if it's as impactful actually as an ETF or a sovereign like announcing. The interesting about ETF is that it wouldn't actually matter, right? Because the ETF would be, if you're holding an ETF on your books, it's going to be mark to market. But I think the real question is like, how many companies have actually been on the fence or have disposed of their Bitcoin holdings like Tesla because of this unfair accounting treatment? I would argue very little, but it's more of a sentiment. I think like you're reading the lines, like the ETF is coming, a more accurate accounting treatment. I think everyone's just sort of realizing this industry is real. Not only that, but it could also bring in meaningful, economic stimulus, jobs, capital formation, and fees for all the different kind of constituents that matter. And so I think that's in my mind, that's the more relevant thing. It's like, it just brings more legitimacy and a fairer treatment to this asset.
That's good.
Yeah, I've always thought it was this like Bitcoin on corporate balance sheets was a bit of a meme and like not something that was actually going to play out that much. I mean, MicroStrategy's obviously performed. It's looking really, really good for them. And
getting a 40-50% premium.
Yeah, so it's looking great for them. But like, I don't know, you don't have corporates going out and buying like stocks and putting it on their balance sheet.
Let me put it this way. Like, I think like, if you think about payments and stablecoins, as that, it likely won't matter, right? Because the question, I think if you're holding a stablecoin in your balance sheet, I'm not actually sure if the treatment would be like a long-term intangible. I guess it's sort of TBD because we don't really, but presumably with a stablecoin bill, like it would be treated like cash equivalent. But, if you're accepting payments in other currencies or whatever, and you're getting SOL and ETH in your balance sheet, then I think this more favorable treatment. Now, I'm making an assumption that also...
I say if you're accepting payment in SOL and ETH, yeah.
Now, this makes the assumption that I'm not actually sure if this applies to things other than Bitcoin, but let's just assume that it does. I think it matters more longer term for commerce, where there may be less of an incentive to dispose of what you're getting and swapping for cash if you have this type of treatment, right? Which sort of makes sense. If you're getting payments in ETH and SOL, if you're selling it,
like Blockworks does. Blockworks gets payment in crypto all the time.
Exactly.
Yeah.
So yeah, I don't know. It's on the margin. It's more of like accounting, and I think for what it's worth, an ETF and a sovereign coming out saying that it's going to buy these things is way more impactful. But agree to disagree with these folks.
Yeah, one step forward though in the right direction. It's cool.
Yeah, absolutely.
Okay, less good news. We've got Ledger, so maybe I can take a step.
The times that we talked about Ledger incidents in this pod in the last year.
Yeah, but where, like, and how much money do you have on your Ledger? Like, still,
Yeah, I mean, like, let's talk about what happened and then like dissect it a bit.
Okay, so Ledger launched. I'm gonna do my best here. Ledger launched something. Yeah, Ledger launched something called the Ledger Connect Kit, which is basically a JavaScript library that implements a button that allows users to connect their Ledger device to third-party apps, like a Uniswap or Aave or kind of any DApp. Basically, there was an exploit at some point this week. I've got the timeline pulled up here so I can get into the details.
I think it was hours ago.
This morning?
Not even
hours.
It was.
It was this morning. It was this. So we're recording this on Thursday. It was this morning.
It was 9 a.m. UTC. I pulled that from the CTO of Polygon, which is Moody. I think he's pretty on top of this stuff. 9 a.m. UTC. That was like 9 p.m. my time. It would have been early your morning, I guess.
Yeah. So what happened is there was a former employee that fell victim to a phishing attack, which then allowed a bad actor to upload a malicious file to Ledger's npm.js, which is this like package manager for JavaScript code that's like shared between apps. And basically any app that you connected to that used ConnectKit now had this, I think, a drainer basically inserted into it. So you had the potential to basically have your wallet get drained if you interacted with any of those apps that used the Ledger's ConnectKit. That's my high level.
And by interaction, it's not just connecting; it's like it's like signing a transaction.
Signing, yeah. So, yeah. So I think the TLDR is you had this malicious version of the Ledger Connect SDK that was pushed to, basically pushed into the like live code.
And what's important is, as soon as this happened, my understanding is it sort of gets rolled out to pretty much most apps by default, like automatically.
I think it was any app that used Wallet Connect.
Any app that used this would have approved. Now, yeah. So the affected chains, there were a lot. Basically, most EVM, like it was obviously ETH-L1, all the different Base, Arbitrum, like Polygon. Basically, it was just like, I think it was containing most of those apps. There was some chatter about Solana, but I think it was largely unaffected because most teams don't even use them. I pinged the Soulflare guys as soon as I woke up and saw this, and I was like, guys, are you affected? And they're like, no, we actually have a very strict policy of how when you connect to the app, like we there's like a second layer here, so they're not affected. A lot of projects have come out saying so I guess the patches, the vulnerability has been patched, right?
It's been patched. Yeah, it's fixed. You have to you should though update your I think even though it's fixed on Ledger's end, there is still a way, don't quote me on this, that the malicious code is still cached on browsers that have if you have visited a compromised front end and hadn't made a transaction, it's still cached on your browser. So for me, like I just cleared my browser caching. I was like, did I do something on chain? I was like, I don't really remember. Cleared my cache.
I guess the important thing is if you haven't used your signed within or used anything on chain for the last like day, call it that for conservatism, I think you're fine. Everyone seems to say that, but just for caution, and you can never be too cautious in this space, is just clear cache your browser to whichever one you use for interacting on the chain.
Yeah.
And then wait, like just don't do anything, right?
I know.
The knee-jerk reaction is, oh, I'm gonna go and revoke everything and move. Like just for again.
Yeah.
Do not do anything.
I was gonna send USDC today for like an angel check, and I was like, you know what? I just told him, I was like, I'm gonna send this on Monday. Like I'm just not interacting on chain for a day or two. Like
I say, guys, yeah, it's you're gonna be listening to this on Friday. Just don't do anything and take some time.
Okay, so I have a couple questions here. So the way that I understand the origins of the Ledger, the way I understand the origin of this exploit is that there was this ex-developer, Junichi Sugiura, I'm sure I'm botching that name, that still had access, even though he was an ex-employee, still had access to the GitHub repo. He clicked a link in a phishing email targeted at GitHub users. His GitHub account got compromised, and then bad actors pushed that malicious code into the library via his account. Why? Twofold. Why did this ex-employee still have access to a GitHub to Ledger's GitHub repo? And two, why don't they have two-party like verification for code updates or something? Like, why do they have it so that a single person can deploy code without review by any other party? That's crazy to me. That's crazy.
You shouldn't have surprised.
No, but actually, like, you should have access controls, internal reviews, multi-sig codes when it comes to like.
It's stupid, huh? I don't know, dude. I literally, it's the third strike or more that we know for.
I don't know. Pascal's speaking at DAS in March, so well, I mean, I'm sure they'll be past this by then. But it's like, I don't know. You got a company that's fundamentally built around security, and I'm sure 99% of the times this happens. But like, you can't have a 1% moment, you know?
this is like a class. This is like probably there's a couple of things that are very on edge when they happen. I think just the good thing is the entire crypto Twitter, everyone was on top of it fairly quickly and alerting people. My latest check is that the drainer has gotten like 500K of funds, maybe 600. I've also seen that it only included like gas tokens could be drained, so not ERC20s, only gas. So that would be, ETH or SOL, meaning the units that you pay for gas. Now I haven't verified that. I just saw one tweet around that, and then there's a revoke. I retweeted this. There's a revoke app site where you can go and enter your address if you have any doubts, and it could actually tell you the approvals that you have.
What's it called?
The Revoke Cash app. I think it's I read it. They have a specific site where a specific part of their site where it will check your wallet and the approvals interactions you've done and tell you if you're safe or not. Now
revoke.cash, that's what it is.
Yeah, revoke.cash. But anyways, it's on my Twitter profile. We'll link it here in the show notes. If you have any doubts.
There's also two others I'd give a shout out to, which is Wallet Guard and Pocket Universe. So I haven't used either of those. I have no affiliation with them, but I saw some people tweeting out saying like Wallet Guard flagged this immediately. Like big, very big Wallet Guard.
And I guess the important thing here is like, so let's unpack this a bit. Like, what is the issue here? I guess the supply chain attack is real, and it's a real threat to the industry, right? This came up also in May of earlier this year when Ledger kind of came out with the social recovery feature. Everyone's like now unpacking like, well, no one's actually been able to verify like it's like closed source, and is there a back door? Like that's always a risk, right? And so you're kind of trusting these people when you do these upgrades. Like there's no malicious code, right? You go on Ledger Live, you update your ledger, you're inherently there's always trust for all these wallets. The key, it's just sort of risk. And so, yeah, when the supply chain attack happens, it's pretty bad. Now this, good thing it was just really contained. And then like zero-day exploits, right? Chrome and all that stuff that just affects a bunch of people. But nonetheless, I think it raises a couple of things that I would love to get your take and just talk about. One is just this, as an industry, when these things happen, you appreciate how like the dependencies, right? And certain areas of vulnerability. And I think this is just like, how do we overcome that? What can we do to make this? Like, I guess like blind signing is something that I know has been talked about as removing it and just creating a better flow. The other is just like, you sort of assume that people are just going to click their ledger and not really, or their hardware wallet. And when they're signing a transaction, they're probably going to be careless or not really understand the full details of it. It has happened to not only, less sophisticated user, it has happened to so many sophisticated people. The Nexus Mutual founder, for instance, so you get a compromised version of MetaMask that you just sign, right? Anyways, my flow, and I know you wanted to talk about like having Tay and other people to have a very dedicated pod on security, but like my advice is when you see this stuff, don't overreact, understand what's happened, follow a couple people, and we can link them in the show notes, folks that I might like, but also take time to like, so if you're using MetaMask and you're signing, right, you can always I always inspect where it's going, right? So when you're actually proving you have that page, shows up the fees on the top right, you can actually see the destination address. And so whatever contract you're going to be interacting with. So what do? I check that address. I go into Etherscan or whatever scan to see that address. And just by quickly inspecting that address and all the transactions that are happening, it may be tagged as safe, but even then, just click into a couple of transactions, look at the history of the contract, understand what the contract kind of does. You don't have to be extremely technical. If you just click into that and say, what is this contract doing? Like, what are the last 20 transactions? So click randomly on 5 and understand what those transactions are doing.
I know,
It's a
but
new
listen to what you're saying. That's so insane that you have to do that. Like, you're sending something on chain, you then have to go look at the address on Etherscan, look at 5 transactions. Like, my dad was just in town in New York, and I got him set up on so he's been set up on MetaMask, but he's set up on Solana. He's got a Phantom wallet, he's trading on Jupiter, he's got a MetaMask wallet, he's trading on Uniswap. He wanted to buy some like weird long tail things that he read about in a newsletter that he subscribes to. And so I helped him buy them. But then this morning, and he's not on crypto Twitter, right? He doesn't have a Twitter account. This morning I had to text him, do not open MetaMask or Uniswap or any of that today. And I didn't know how to describe it to him, so I just said big industry-wide bug. Like, think of the, hopefully as crypto grows, like that he will be in the 99% of users who aren't like spending all their days on crypto Twitter. That's just
my second advice, which is probably the best one. You got to assume in this chaotic phase of innovation, ever expanding surface area, there's going to be exploits, continue to be exploits. So my approach is do the Horcrux model, separate. It doesn't cost anything to spin up new wallets. Break it down. Have a hot wallet for doing NFTs, trading, and then send those to a vault that is never interacting with anything. I think it's just proper hygiene, where the same whether you have a checking account and a savings account, or you have you have different bank accounts. Same here, guys. You use hundreds of wallets. I know you want the convenience of aggregating and seeing how much you're worth on a tick by tick basis, but guys, like, you can aggregate that. You can track that easily. What you don't want is to have one wallet with all your assets. You do a wrong click and it drains it. And so, I think I was, for instance, active during this period. I was doing some agent stuff on chain, and it actually happened during this time. And so I immediately knew which wallets I had interacted with. I checked. I looked at what had happened after, and so what I'm trying to say is it was contained to like less than 0.05% of all my assets. So it's like, a worst case scenario where I just, got to get affected by this. It doesn't destabilize me, just sort of like you live. And so I think that's my best approach, right? If you don't trust Ledger, well, maybe get other wallets, or maybe get 3 of them, have a multi-sig where you're using different hardware wallets. Like, there's a lot of things you can do. I definitely agree with you. Look, it's not
yeah. I mean, it makes you zoom out and just think about things. It's like, yeah, there's Ledger's had a bunch of fuck ups recently. But I'm like, okay, like what else am I going to go use? Like, I'm using Ledger still. And then it makes you think about like wallets too. Like, everyone in the industry uses MetaMask, which is run by the same company that also runs the largest RPC provider. And it's like, there's anyways.
Moments like these are always when people start digging in and understanding there are still a lot of dependencies.
Yeah.
People talk about NFTs and like where the data is actually stored. Yeah. You think how many people care about that? No, they just want to look at like nice pictures on the phone. Yeah. Well, are you certain that metadata is stored in a like immutable like way, or is it just stored in like, you know what I mean? Like, it's important to dissect all of this, but you go down this rabbit hole from as you know, security is an area that I've been mostly focused on for a long time. And there's many ways to attack security and like improve security. I would say there's a lot of people focused on that, but it's still challenging.
Yeah. All right. Anything else on this topic?
Well, as an aside, like I had this idea of like a wallet flow, and then Tay was like pretty vocal around it. She didn't like the proposal, but I'm like, why don't we by default? Like, if we assume that most users are going to come from in some of these mobile wallets, Argents, Phantoms, or whatever, Soulflare, pick your flavor, then I think there's a big opportunity to embed certain security features by default for your users. And sure, it may compromise user experience on the margin, but I think that's easier to overcome with like training, right? and the user with some guides. Like setting them up with a couple of wallets, a Vault wallet and a Hot wallet, and different wallets for NFTs and DeFi and just core holdings. And for any approval, like if you're a wallet, for any approval of a new contract, it simulates a transaction for you, and warns you. And there are features like this that would warn you, hey, are you sure you want to send all your 25 Dorians to some brand wallet? Well, probably not. And so I think we're getting better at this, but alerting and simulation of transactions is probably the easiest and lift for a lot of users, which still, they're not going to understand what the contract does. They're not going to understand anything, and they're just going to click immediately. But anytime you're interacting with a new contract, there's a delay. Stuff like this. I think there's a couple of ways that we can probably improve this at the wallet level. That's I think where a lot of these changes by default, and it can have a huge improvement in protecting a vast majority of users.
All right, everyone. So we talk a lot about the institutions coming into crypto on Empire. Santi and I are both headed out to London March 18th to 20th for Blockworks' 8th ever Digital Asset Summit, DAS. This is an institutional buttoned up conference that we've hosted since 2019. I like to joke that it is probably the last remaining kind of suit and tie event in crypto. People are still wearing suit and tie. It's pretty funny, but you'll actually hear from a lot of the largest institutions in the world, coming from Standard Charter, FIS, JP Morgan, Framework folks coming out, Wintermute, Van Eck, Goldman Sachs. There are a couple big themes of this conference. 1, Bitcoin catalysts, the halving and the spot ETF. 2, a view from the buy side. 3, RWA's tokenization and stablecoins. 4, global regulatory frameworks. 5, institutional infrastructure, including banking and payments. And 6, the macro case for crypto. If you have anything to do with the institutional side of crypto, you have to be there. Santi and I got your back. We hooked you up with a 20% off code. It is Empire20. There is a little competition running internally at Blockworks to see who can drive the most number of tickets. So help Santi and I out. Register with our code and you get 20% off. That is Empire20. All right. What do you want to talk about next? Do you want to talk about these points?
Sure.
I mean, I don't get the hate on the points that I don't understand why everyone's so up in arms about points. So Rainbow launched points on all right, so Rainbow tweeted out on Tuesday saying, "Welcome to Rainbow Points, the first step towards including our community in the future success of Rainbow. Every Ethereum user has been dropped points today. Claim your points and start earning more by doing the things you already do on chain. So use Ethereum, earn rewards. Do things, get rewards. Like play on chain, get rewards." What is so the pushback here?
I want to ask what points are going to be awarded.
I don't hate it. Like I don't get why like I don't know. My wife shops at Sephora and like she gets points for doing that. Like IKEA gives you points, Microsoft gives you points, like Starbucks gives you points.
If you're already using it, like you don't mind it, and if like. Yeah, I don't get it. People are just in this state of, why do we need another L2? And I hate the strategy. And look, I don't know. I'm all for experimentation. And I don't think, time and time again, people get frustrated. Like, why do we need another L1? It's a copycat and yada, yada, yada. It's like, instead of like bitching about it, like it's gonna happen anyway.
Yeah, let the innovations play out. Like let people do points. Yeah, I don't know. Like I have no issue with these points.
If they want to do points or call it whatever, like fine by me. Like ultimately, like I don't see a problem with that.
So were you on the Tushar podcast that we did when he was talking about every cycle has its own novel token distribution? So you had ICOs in 2017. I think it was IDOs in 2019.
Binance really kicked off.
Remember the Binance IDOs in 2019, and then you had you had DeFi summer and like airdrops and things like that. You had NFTs. Like there's always these new novel token distribution things. Now the new novel token distribution is points, and I think points are basically becoming this system's mechanism of token distribution.
Yeah, of course.
Yeah. By the way, I have a startup idea for you, which is that I want to get your take on.
That I'm a builder or an investor or both?
Probably from the I know you're a bad builder, so we'll approach it from the investor's perspective.
I love this as a builder.
Okay, so I was talking to some of the teams on on Solana that are launching that have recently launched tokens and done these airdrops and are launching tokens. And I was listening to the 0x Research podcast with Lucas from Jito, and he was just talking about how hard, like a lot of these founders are just like, it's so hard to prevent Sybil attacks or Sybil, however you pronounce it. And it's really, really hard to prevent the gaming of airdrops. Why isn't there a company that shouldn't be on the founder to figure out how to build a system to prevent that? Why isn't there a company?
There is one.
What's it called? I'm sure you're invested.
I've looked at two and I
Passed, but CK CAPTCHA,
ZK CAPTCHA.
CK CAPTCHA.
Yeah,
that's the one I looked at.
That's
Smart
a
guys.
name.
Well, hey, can't get everything right in crypto.
That's true.
I think names. It's
a Cloudflare for Web3. Capture service that verifies challenges on the smart contract level. I guess that is how it's done in Web 2, is you have to do CAPTCHAs and verifies it.
Look, we're getting better and better and more sophisticated at preventing what is for unsuspect, just to level set the conversation. What happens in crypto is you can have multiple wallets, and so tied to one person, and so it's not like you can claim a free pizza in your student council by showing up and showing your ID. Here, no one's asking for your ID, so you can have 50 versions and clones of you showing up to get the same pizza. So all of a sudden, you get all the pizza, and that's not good. And there have been instances where that has been an issue. It has, there's always some farmers out there. You hear that picture, that guy riding a scooter with 50 phones in China, and he's clicking all. That's basically what you're trying to prevent. You're trying to distribute these tokens to as many people as possible, not just one. But yeah, with AI, you can. I think we've gotten better at understanding bot behavior, and preventing just them getting a disproportionate share of airdrops. I think I've also thought a lot about and discussed this with teams about how do you think about airdrops, and the programs of airdrops. Like Jupiter, for instance, announced that they were doing one of many airdrop campaigns. Blur has done multiple rounds, right? Not just one. Simple things like that, I think, are pretty good, right? Ultimately, what you don't want to do is blow your entire load in one airdrop, and it's well, then up to governance you can distribute. But it's I think it's better to have a lot of flexibility. And have multiple campaigns, because you're going to also get a better sense of retention, user behavior. You don't want to be in a position where you totally gave all the airdrops, and then you don't even have anything and more firepower for marketing and acquisition.
Yeah. So I think a lot of companies basically there's a lot of examples in crypto of basing things off the first time something happened. For example, what I'm talking about here is out of every NFT collection is 10,000 PFPs. Why? Because first big one was basically but to tie this together with this conversation, I think a lot of companies or protocols in crypto, whatever you want to call them, have fixed supply of tokens because Bitcoin's 21 million hard cap. But if you think about how a company should be built, that fundamentally does not make any sense. You should have more and more shares that get issued as the company grows and needs to do more things with their equity. And so I think when I see these pie charts where it's 20% to investors, 20% to the team, I'm what a stupid model that we're even focusing on this thing. It's you should have. I don't.
I hear your point. Look at static. Point in time, you have to kind of chart, say this is the distribution of this value.
No, I get what you have to do it. Yeah.
But I went through the exercise of making the proposal for Yarn to mint an incremental, 4,000 Wi-Fi, because of course they needed to fund the developers, right? And new, ongoing development of the protocol. And they had all the Wi-Fi had been formed. But I agree with you. I think ultimately the response to that is, yeah, maybe you fix the supply, you have some inflation to because that's what the market, like, that's just I think still good to do. But then say, look, I know we're gonna have a discussion tomorrow with Kyle and Dimitri, I think, on DeepIn. I think certain use cases, to your point, gaming, DeepIn, require like more thoughtful approach to token emissions and inflation on a dynamic manner based on user activity, based on, like, it's very different if you have, like, if you're a game and you said, oh, we're going to have 10,000 PFPs. Well, good luck this being a mainstream game, guys. Like, you basically are capping your users to 10,000. That's not going to fly. Okay, maybe you can launch derivative PFPs, which is where most other teams have gone in this direction, right? Like Asuki's did like a clone of the
Original Asuki's, but that
Yeah, but that never.
other teams have done it more successfully. So I think, like, yeah, to your point, you're absolutely right. We've been operating under this assumption in crypto around scarcity driving value, whereas for gaming, for NFTs, for social, it is a like utility, and that is abundant. And so you want to have, if you want to have billions of users, when you want to have like all these different collections and maybe tokens. Now, maybe the counter argument to that is, even if you have a fixed supply, well, you can divide these units up to like companies go through this motion too, right? Once the stock price goes up over 100, $200, they do a stock split, because unit buy, like unit, what do you call it? They're unit bias, right? Oh, you can buy 40,000 Bitcoin. Oh, you can be a Shiba billionaire or a Bong billionaire. Psychologically, companies, even in the public markets, have realized this. Once their stock price reaches a certain level, 100, 200, 300, psychologically, because you can only buy one share, it boxes out so many people. They do these splits so that the stock is $2, $5, $10, right? Apple's done this. Like, the best companies have done this, right? It's not like only inherent to crypto behavior, but I guess, like, you can divide Ethereum and Solana and all these different tokens into, 18 zeros are basically infinite. Well, not infinite, but like near infinite. You know what I mean? But still, yeah, I don't know. There was one thing I want to talk about. I watched the Layer 2 video, Layer 0 V2.
Layer 0.
So Layer launch is sort of this communication protocol. Full disclosure, I'm an investor. I think the team's extremely talented, and they launched V2. There's a great video with Primordial, the founder, Brian. People should go watch that, because I think he like, why I think this is relevant is because he talks about like the importance of security liveness. He talks about, and decoupling that, he talks about the importance of communication and the core principles of crypto, like immutability, censorship resistance. And I think it was just like a really put together, a very good video. Even if you don't care about Layer 0 does, I think it's still a good video, because it talks about the kind of the core ethos of crypto. So it's really nice. The point I wanted to make is, a lot of times you can change these things up to governance. So obviously, the idea of how many tokens are emitted, like some of these parameters, not immutable. Like, it's not like Bitcoin set in stone, but like, you can in theory upgrade a lot of these parameters for many protocols. And I go back and forth on that. If these are things that can or can't be upgraded at the smart contract level. I think you can make arguments for both, and certainty of not having it ever be upgraded. But I think certain features, maybe like token supply, may, if there's a quorum, but I don't know. I'm not.
Wait, so just to make sure I understand it correctly, Layer 0's, the V2 basically upgrades the architecture, and the main change is that it decouples the security and the execution. Is that the?
It's really liveness. So like, I'm gonna butcher explain it. I'd rather not, but I think
what does liveness even mean?
Well, like basically, like, what Layer 0 allows you to do is, like, for instance, say you want to swap a token. You're an Ethereum L1 and you want to swap a token in Arbitrum, but you don't have any tokens in Arbitrum, right? Or you don't have any tokens in Base, and you want to go across these chains. What they've done is they would just make that extremely easy, abstract all the complexity. They will swap your tokens in one chain for that in the other, and then execute whatever transaction you want to do. And so I think that's like super important. It can also be for voting and other components. So a lot of it is when you think about the communication between chains is my appreciation is, well, how quickly that happens, with what certainty one chain is more secure than the other. So you have to deal with like different mechanisms, consensus, validation. Like basically one chain is more secure than the other. It's just like, it is fairly complex thing to do when you think about all that. And Layer Zero is just doing it in a, I think it's a big improvement in what they've done in making that just far easier for people to interact across chains. So
that's cool. Taking a bit of a different approach from like Axelar and CCIP and Wormhole, and that's cool.
Yeah.
Is liveness basically like what like the ability of a distributed system to process transactions? Like what is?
Yeah, I think that's a good way of putting it.
I gotta ask our analysts. By the way, we just published a report on Layer Zero. I just saw on our research platform.
I haven't read that.
So we'll link that in the show notes. Today's episode is brought to you by Northstake, the secure and compliant staking platform for institutional investors. Northstake is purpose-built for institutions that want to enable the ability to move in and out of staked ETH seamlessly while controlling all aspects of their fund management. Northstake's tokenized ETH staking service offers institutions easy, low-risk crypto yield opportunities. It complies with both AML and MiCA regulations, making it possible for institutions to tap into Ethereum's growth and earn staking rewards even through these pretty turbulent regulatory times in crypto. If you are an institutional investor seeking compliant crypto exposure and yield, Northstake streamlines that all for you. To get started, head over to northstake.dk/tokenized-ETH-staking. I know you're probably not going to go to that long URL, so just click the link in the description of the episode. That'll take you right to Northstake's site, or if you're on YouTube, scan the QR code on your screen right now. Now, let's get back to the episode. My prediction for we're going to do a predictions episode next week, which I'm pumped on. But one of my predictions that I've talked about in here before is that BLAST is fine, but what BLAST is going to cause is all these L2s starting to create L2s with yield. And we saw that for the first time this week with Manta. Is that right? Manta? What is Manta?
Well, I full disclosure, also an investor, a seed investor, way back in the day. So their privacy, their whole thing was privacy since day one. It's like, we need better privacy.
I remember these guys. Yeah.
IT guys, and so they're very focused on, again, like a privacy chain. So that to me was the most compelling thing. They're still in that direction. They're launching now their L2. Like a privacy-focused L2, and of course they dubbed it the new paradigm, and so a lot of it is native yield.
Is that a jab? Is that a jab at paradigm for funding BLAST?
Well, I mean, I don't think it's a coincidence. And they're using, I think, the different mechanism that they're doing. And I had a call with Kenny, the founder, not too long ago, actually 2 days ago, about like they're using Mountain Protocol, which I think Newcastle, like Nick's fund, is an investor in, which is basically, I think we talked about this in the pod when he was on, but basically it's basically like a treasury yield bearing stable coin. And they're using that to capture yield. And the same way that BLAST is using Maker and Lido to capture yield from treasuries, Lido to capture yield from native ETH staking. Manta's taken a similar approach by using Mountain on the stablecoin side to capture treasury yield. But yeah, you're right. I mean, I think it's once someone does it, then everyone else will do it. If it works, everyone else will do it, and that's the nature of the space.
Yeah, and something like Manta's going to be fine, and then someone else has 5% yield, and then someone's got 10% yield, and then someone offers 20% yield. Now we've recreated, it's this cycle's version of Celsius and BlockFi.
No, see, this is where I struggle with that, because I know you're going there. Mike, I saw a tweet from Mike, your co-founder, that he said this, right? He said this is going to be a problem because it's Ponzonomics and yield people are going to chase high yield. But I agree. Look, this happened in DeFi summer. New protocols were launched. They advertised yield. in the thousands of APYs, and then that very quickly compressed for a variety of reasons. Primarily, the token price collapses as like, you know, sell pressure start as soon as you start farming. Like there's a lot of mercenary capital, but it's a very different thing. It's not like, so if you're a Celsius user and you're advertised above average yields on your Bitcoin or ETH, then you're like, okay, great. I'm going to trust Celsius to do whatever it is that they're doing on the back end to give me 2% higher yields or even more. Well, turns what? That was not the right thing because they were taking a lot of risk. They were not doing proper due diligence and underwriting for a lot of their counterparties. The difference between all of this happening on chain is that
you can see where that money goes.
Exactly. Like the counterparty risk is, you're taking, no matter what the yield is, you're taking smart contract risk always. Like, and no one should ever use the term risk-free ever for anything. There's always risk in even treasuries. There may be a benchmark rate, but there's always risk, whether you want to see it or understand it. That's your problem. So there's always going to be a risk of interacting with any contract, whether it has yield or not. Yield is an incentive. Whether you understand where the yield comes from is a different thing. But safe to say is that the higher the yield, the higher the risk and dependencies and interactions of a smart contract. So I don't think it's an issue, actually. No, they Manta or BLAST or Protocol XYZ may offer points and they may say that their token's worth $1 billion and a gazillion FTV. Well, we all know what happens, right? Yields compress very quickly and capital is very mercenary. The other thing that you have now is you have this sort of like natural rebalancing of, you have ETH staking, which is the benchmark rate. Think about like that as buying treasuries on chain, right? I'll say it is kind of like if you hold ETH, staking it, and whatever yield you get, that's like the benchmark rate. So say you're earning 4% staking your ETH, and then all of a sudden that goes, that goes, a lot of ETH people staking ETH say, oh, wait a minute, I can earn 5 times more with this other protocol. Let me unstake and go there. Well, what happens, right? They'll go and chase that yield. By virtue of more demand, that yield goes down, and the ETH yield goes up. So what does that do? That's a natural rebalancing, right? Some people say, oh, well, yield is now like 10% here, and ETH went up to 6. Well, 4% incremental is not worth the risk. I'm going to go back. And so there's a natural
like DeFi summer where you'd run into a pool, the pool yield would go down, you'd chase into another one, it would rebalance.
The nice thing here though is that you have like this kind of you have this benchmark, which is going back to like the base asset like Ethereum, right? Or Solana to stake it. And so just changes the dynamic a bit on the margin. So capital should be more efficient. Because before it was like if you held ETH, you could deposit an Aave or compound and clip like whatever you yield. When there was like a lot of degen leverage on chain, you could be earning a pretty penny on the borrowed assets that were in high demand. But now you can just do it without even interacting with a money market and taking that risk of that protocol incurring bad debt. You're like depositing your money in a bank. Here, you're just keeping your money by staking it. And so, anyways. I think it's an unfair characterization is what I'm trying to say. If you say it's no different than Celsius, and
I don't think this is no different than Celsius. I think what this causes is people launching products that are basically marketing what will eventually be yield that is not real yield. They're, like today, like Blast is great. Like, or I don't know if it's great or not, but Blast puts your money in what, Lido and Maker Treasuries. That's totally fine. But then some L2 is going to come along and put it in something riskier. And then someone's going to basically take your capital and do like a hedge fund like strategy with it.
How's that any different from you putting your money in the bank, by the way? Do you know where that money's being invested?
I mean, no, obviously I have no idea, but with like
how Bank of America and JP Morgan at that.
Yeah, and that's what caused things like Celsius to blow up.
No, that's what caused Lehman Brothers and the entire fucking financial system to blow up. Yeah, these things happen. They're not inherent in crypto. But my biggest point, and I'll say time and time again, is whenever people are critical of something like Aave and Maker and DeFi, I'm like, at least you know where that money's going. And you have full transparency into that process. Whether you want to look, that's your problem. And that's on you. It's always on you. You always bear the responsibility. It's, at the end of the day, your money. But it's your money when you deposit in these protocols. It's not your money. It's not your money when you deposit in a bank. There's a very big difference. And trying to regulate DeFi.
All right. That's good pushback. That's good.
Like that if I were to end this discussion, I always bring it back to that. In DeFi, you're the bank. You control where that money goes and what these smart contracts can do with that. Sometimes you can approve certain things that these smart contracts can be just like a bank. They can move your money around. They can do these strategies. You have to understand that. But you have you always have transparency of where that money is flowing and going in real time, 24/7, 365. Always. You can inspect and look and revoke access and bring it back. You can't do that in your bank. That's why people have 20 bank accounts or put money in Treasury. Seriously, I mean, that's why DeFi works. I mean, I'd rather put money in a smart contract.
Yeah. That was a preview of the predictions episode, which is going to be a little spicy next week, it seems like.
DeFi and gaming are back. Well, we're also going to, hopefully we spend some time looking at how dumb some predictions were, because I always like to go back.
I have a price question for you. So,
here we
go. Do you think there's any money to be made on like buying like Aave and Uni and these kind of like OG DeFi things, or that's a fool's game?
I tweeted about this too, and I keep saying this because that's what I do for a living now. I should post.
Santi, you're basically an influencer now. How do you feel about that? You're a content creator.
God. I don't know what I am, sir, to be honest. Look, I think do fundamentals matter? It's okay.
Not yet.
Aave makes more fees in a day than Solana, but it's valued at 1/35th. What's the right way to look at these things? I think one way certainly is to look at profitability. Synthetics is having its moment because it can't, it stopped inflation, and it's getting a lot of on-chain like activity through Quenta and all these other products, Lyra, and the whole ecosystem of apps. Per activity, they're making $1 million like this week alone in up and down environments. Basically, you look at that and you say, well, that's pretty compelling. And then you look at, okay, what's the supply? What do I like? If basically a protocol is going to earn more fees in a year than the entire fully diluted market cap, well, I would argue that's a disconnect in value, right? What happens when these buybacks happen? People look at Rollbit like it's trading at a decent discount. There's Rollbit, I think, is priced the way it is because it's fundamentally quite risky on because you don't know, it's non-founders. But like these protocols, like, I mean, Maker's been, you can look at the buybacks on chain and you could think about it. So my argument is, over the last 2 years, if you look at ETH, DeFi to ETH charts, they've been terrible, like absolute dog shit. Are they due for a rebound? I think there are arguments to be made that DeFi is back. It's working. It always has worked. You look at also the stress test that we had earlier this week, when there's like a drawdown, down 5, 20, 30 like percent day, 20%, 10, 20, depending on the tokens. But like Solana DeFi was stress tested, and that was very good to see. And DeFi just continues to work. And so it's always a relative game. I think people also understand and like better infrastructure investments like L1s, like very generalized, like look at Cardano. The less you ship, the more spurs people's imaginations of what can be.
You also have meme coins.
Yeah, look at NFTs with utility. It's like the more you attach utility to an NFT, the more that someone can put a value on it, which drives the price down.
Yeah, I mean, maybe the more intellectual question, fun question is the top 10. How's that going to change over the next year? Because I've always been wrong about that. Consistently been wrong of what I think the top 10 should look like.
Yeah,
And what
XRP's number 5, Cardano's number 8. Yeah, Dogecoin is top 10 right now. Dogecoin is the top. And by the way, it will stay there this whole cycle.
Yeah, it will grow.
I mean,
look at actually the more interesting is 11 through 20. Polkadot, Tron, Chainlink, Polygon, Toncoin, which I think is Telegram's maybe. Shiba Inu, Litecoin is still top 20.
Yeah, Litecoin, exactly. I mean, but like you can make the argument Tron is actually fundamentally like, whether you like Justin or not, putting that aside, like stablecoin. It's actually like the Tron stablecoin is like probably is like the most widely popular in places.
Oh yes, yeah.
Like so that's a stablecoin
play. Tether on Tron is. I mean, also IMX is going parabolic since your podcast with Robbie. That's crazy.
I mean, to say that it was because of my podcast is a unfair characterization. But
yeah,
causation, full causation.
Yeah, yes, zero causation there.
Causation.
But gaming and DeFi are probably two areas that I think are being underappreciated, for sure. But yeah, my top 10 predictions have always been wrong and probably will continue to be wrong. So a part of my brain is entertaining. Well, if it's going to be wrong, then counter trade that and then do what a lizard brain or take the left curve approach. I'll leave you with this, I think, and you and I were talking about this before starting this episode. Again, going back to Xiao, he's a great thinker. He's not afraid to be called out and being controversial. Not because he wants to be controversial, because I think he says things that a lot of people may think but are too afraid to say publicly. And I think he has a great post, and we'll end it there. Not a video or a podcast, not a video or another podcast recommendation, but I will encourage people to go and read Xiao's post on TGens, right? Forget the name of it, but we'll link it. I think it's a very honest, like, expose. Maybe not expose.
You know, it was a counter post to I think Ollie at Andreessen posted something being like, "What are we all doing here if we're all just degenning?" And Chow's like, "You're missing the point, my friend." All right, let's call it a day.
Yeah, absolutely, sir. Hey, anyways, great chatting. We'll be, there's an interesting lineup, right, of new pods.
We have Empire coming out next week. We have Avalanche coming out next week.
Cool.
We got Empire. We got Avalanche coming out next week. We are recording a really interesting debate tomorrow with Dimitri, who used to be at 1KX or Coin Fund.
1K.
Yeah, 1KX. And then Kyle Samani from Multicoin. Kyle is taking the pro deepin corner, and Dimitri's taking the anti deepin corner. We'll release that soon as well. So a lot of good pods.
Yeah, and I'm recording one with the founder of Modulus and Casey, who was at Google and studied AI before it was cool, and one of the best investors in this space, I think, on AI and crypto, and kind of parsing through the narratives and the science. So yeah, a lot of stuff. We try to be relevant and touch on things that we care about and I think are important in the limelight. So if you want to hear anything in particular, let us know. And if we're getting everything wrong, also let us know.
We read the comments.
What do you think is more? What do you think is more of like a neg? Influencer or content creator? What should I call you?
God, I think content creator is like a soft influencer. I'd rather just rip the Band-Aid off, and be like, come, the Lord Jesus, all accepted. But content creator just feels like you're kind of like you're still an influencer, but you're shitty. You haven't made it.
Yeah, you haven't made it yet. You're creating content but not getting paid for it.
I was looking for what it's worth. I like, this ain't making a living, folks, but I do it because it's fun. And so cool. You can call me whatever you want, man. By the way, okay, next episode I will look very different, and I will do something that you haven't actually lived up to. This bet.
Shave your beard?
I don't know. We'll leave it at that. This is the perfect place to. This is the perfect place to end.
Why are you doing?
because I haven't done it in 10 years.
Nice.
And we're entering a new paradigm of because the Fed pivoted.
All right, let's wrap, my friend. Go enjoy your poker games. Go enjoy Kane and the crew out there, and I'll see you next week.
All right, man. Great as always. Thanks
Everyone for listening. We'll see you next week.
Hey everyone, thank you so much for watching today's episode. Really hope you enjoyed it. We wanted to take a second to just remind you about our upcoming Digital Asset Summit in London, March 18th to 20th. Santi and I got your back. Seats are limited, and we hooked you up with a 20% off discount code. It is Empire20. If you heard it earlier in the podcast, there's a little competition running at Blockworks to see who can drive the most number of tickets. So when you register for the Digital Asset Summit, make sure you use our code Empire20. See you in London.